Question 1. Legal and regulatory framework. What is the primary purpose of the Michigan Insurance Code concerning term life insurance policies? A. To determine the maximum premium rates that can be charged by insurers. B. To establish guidelines for consumer protections and ensure fair treatment of policyholders. C. To outline the specific benefits that must be included in all term life insurance policies. D. To define the qualifications needed for insurance agents to sell term life insurance. Answer: B. To establish guidelines for consumer protections and ensure fair treatment of policyholders. Explanation: The Michigan Insurance Code is a set of laws designed to regulate the insurance industry within the state, ensuring that consumers are protected and treated fairly by insurance companies. It addresses various aspects, including licensing requirements for agents, consumer disclosures, and claims handling regulations. This framework is crucial in preventing practices such as misrepresentation or unfair claims denials. While premium rates and agent qualifications are covered under different provisions, the core aim of the Insurance Code is to uphold consumer rights and ensure a balanced marketplace. Question 2. Policyholder rights and responsibilities, scenario-based. Mr. Thompson recently purchased a 20-year level term life insurance policy. After 5 years, he decided that he wanted to convert his term policy to a permanent policy due to changes in his financial situation. What should Mr. Thompson do regarding his policy? A. He should let the policy lapse since it cannot be converted after 5 years. B. He should contact his insurer to inquire about conversion options and any associated costs. C. He should cancel his current policy and apply for a new permanent life insurance policy. D. He should continue paying his premiums without taking any action since conversion is automatic. Answer: B. He should contact his insurer to inquire about conversion options and any associated costs. Explanation: Most level term life insurance policies come with a conversion option, allowing the policyholder to convert to a permanent policy without providing additional medical information. However, this option usually has a specified time frame within which it can be exercised, and there may be costs associated with the conversion. Mr. Thompson should contact his insurer to understand the specifics of his policy regarding conversion, including any time limits and the new premium rates for the permanent coverage. Options and D are incorrect as they misinterpret the nature of conversion. Option C may not be necessary, especially if conversion is available without new underwriting. Question 3. Types of term life insurance policies. Which of the following statements accurately describes the characteristics of decreasing term insurance? A. The face amount remains constant throughout the life of the policy. B. The premiums are typically lower than those of level term policies, but the face amount decreases over time. C. It can only be used for a maximum of 10 years and does not provide any cash value. D. The policyholder has the option to convert it to a permanent policy at any time during the term. Answer: B. The premiums are typically lower than those of level term policies, but the face amount decreases over time. Explanation: Decreasing term insurance is designed to provide coverage that decreases over the term of the policy, usually aligning with a financial obligation such as a mortgage. Because the face amount diminishes, the premiums are generally lower compared to level term policies, making it an affordable option for those seeking to cover specific debts. Option A is incorrect since the face amount does decrease. Option C is misleading, as there are policies with terms longer than 10 years and these typically do not have cash value. Option D is also incorrect. While some term policies offer conversion options, decreasing term insurance may not universally provide this feature, and any conversion would be subject to the policy's terms. Question 4. Premium calculation and underwriting. Which factor is least likely to affect the premium rate of a term life insurance policy? A. The applicant's age. B. The applicant's occupation. C. The applicant's favorite color. D. The applicant's health status. Answer: C. The applicant's favorite color. Explanation: When determining premium rates for term life insurance, several factors are considered, including age, health status, and occupation. These factors help assess the risk associated with insuring the individual. Older applicants generally face higher premiums due to increased mortality risk, while those in higher-risk occupations may also pay more. Health status is critical, as individuals with pre-existing conditions may be charged higher premiums or may be deemed uninsurable. However, an applicant's favorite color has no bearing on their insurance risk and thus does not impact premium calculations. Question 5. Policy provisions and riders. Which of the following riders provides additional coverage in the event of an accidental death? A. Waiver of premium rider. B. Accidental death benefit rider. C. Terminal illness rider. D. Children's rider. Answer: B. Accidental death benefit rider. Explanation: an accidental death benefit rider offers an additional payout if the insured dies due to an accident. This rider can significantly increase the total benefit provided to beneficiaries in such unfortunate events. The waiver of premium rider allows the policyholder to stop premium payments if they become disabled but does not add coverage. The terminal illness rider permits the policyholder to access a portion of the death benefit if diagnosed with a terminal illness, while the children's rider provides coverage for the insured's children but does not pertain to the insured's accidental death. Question 6. Emerging trends in term life insurance. Which emerging trend is significantly influencing the term life insurance industry? A. Increased reliance on traditional underwriting methods. B. Growth in telehealth services for medical underwriting. C. A reduction in the use of technology for claims processing. D. Decreased consumer interest in online policy comparisons. Answer: B. Growth in telehealth services for medical underwriting. Explanation: the use of telehealth services has gained traction in the life insurance industry, allowing insurers to streamline the underwriting process by using remote health assessments. This innovation makes it easier for applicants to provide necessary health information without needing in-person medical exams, thus enhancing the application experience. In contrast, traditional underwriting methods are declining as technology becomes more integrated into the process. Additionally, the trend of consumers comparing policies online is increasing, not decreasing, further demonstrating the shift towards more tech-savvy insurance practices. Question 7. Claims process. When filing a claim for a term life insurance policy, which document is typically not required? A. Death certificate of the insured. B. Original policy document. C. Medical history of the insured prior to purchase. D. Claim form provided by the insurer. Answer: C. Medical history of the insured prior to purchase. Explanation: when a claim is filed, the necessary documentation typically includes the death certificate, the original policy document, and the claim form provided by the insurer. The death certificate proves that the insured has passed away, while the original policy verifies coverage at the time of death. However, the medical history prior to purchase is not needed at the time of claim since it is already considered during the underwriting process when the policy was issued. Therefore, this information does not play a role in the claim itself. Question 8. Types of term life insurance policies. Which of the following statements regarding annual renewable term insurance is correct? A. The premium remains constant for the entire term of coverage. B. The policyholder can renew the policy annually without undergoing a medical exam. C. The coverage amount increases each year. D. It typically accumulates cash value over time. Answer: B. The policyholder can renew the policy annually without undergoing a medical exam. Explanation: annual renewable term insurance allows policyholders to renew their coverage each year without needing to provide evidence of insurability, i.e., a medical exam, making it flexible for those who may have health concerns. While premiums for ART typically increase with each renewal due to the insured's advancing age and changing health status, they do not remain constant. The coverage amount does not increase. It remains the same unless modified by the policyholder. Additionally, ART policies do not accumulate cash value as they are pure protection plans. Question 9. Problem-solving skills. An insurance agent is reviewing a client's financial situation to determine the appropriate term life insurance coverage. The client is a 35-year-old male with a $200,000 mortgage and 2 young children. Based on this information, what is the most critical factor the agent should consider in making a recommendation? A. The client's favorite hobbies and interests. B. The client's current income and potential future earnings. C. The client's existing savings and investment portfolio. D. The client's age relative to his parents' life expectancy. Answer: B. The client's current income and potential future earnings. Explanation: when recommending term life insurance coverage, the agent must focus on the client's ability to provide for his dependents in the event of an untimely death. This includes understanding the client's current income, existing financial obligations, such as the mortgage, and potential future earnings, as these factors will help determine the necessary amount of coverage to ensure that the family is financially secure. While hobbies, savings, and family life expectancy can offer context, they are not as critical in assessing immediate financial needs for life insurance coverage. Question 10. Critical thinking abilities when evaluating different term life insurance products. Which of the following should be the primary consideration for the policyholder? A. The marketing materials presented by the insurance agent. B. The overall cost of the policy compared to competitors. C. The financial stability and reputation of the insurer. D. The aesthetic appeal of the policy documentation. Answer: C. The financial stability and reputation of the insurer. Explanation: the financial stability and reputation of an insurer are paramount when evaluating life insurance products. A stable insurer is more likely to fulfill its obligations and pay claims when needed. While cost is an important consideration, it should not overshadow the insurer's ability to provide long-term security. Marketing materials and the appearance of documentation may be persuasive but are not as crucial as understanding the insurer's track record for financial reliability and customer satisfaction. Ensuring that the insurer is well rated by agencies such as A.M. Best or Standard & Poor's is essential for the policyholder's peace of mind. Question 11. Legal and regulatory framework. Which of the following statements best describes the primary purpose of Michigan's insurance code? A. To regulate the marketing strategies of insurance agents. B. To protect consumers by ensuring fair practices within the insurance industry. C. To set premium rates for all insurance policies sold in the state. D. To determine the qualifications necessary for insurance agents. Answer: B. To protect consumers by ensuring fair practices within the insurance industry. Explanation: the Michigan Insurance Code primarily aims to protect consumers by establishing guidelines and regulations that promote fair practices within the insurance industry. This includes ensuring that insurance companies meet certain standards of financial stability, providing clear information about policy terms, and addressing consumer complaints. While it does touch on agent qualifications and marketing practices, the overarching goal is consumer protection. Premium rates are generally influenced by market competition rather than being strictly set by the insurance code. Question 12. Types of term life insurance policies. Which of the following is a defining characteristic of decreasing term insurance? A. The death benefit remains level throughout the policy term. B. The premiums are typically lower than those of level term insurance. C. The death benefit decreases over the policy term, often aligning with a declining financial obligation. D. The policy accumulates cash value over time. Answer: C. The death benefit decreases over the policy term, often aligning with a declining financial obligation. Explanation: decreasing term insurance is specifically designed so that the death benefit decreases over the policy term, making it ideal for covering debts like mortgages that decline over time. This characteristic allows for low premium costs compared to level term insurance, but it does not accumulate cash value as it is a pure protection product. Understanding this distinction is essential when advising clients on the appropriate coverage for their needs. Question 13. Premium calculation and underwriting. In the underwriting process, which of the following factors is most likely to be classified as a substandard risk? A. A 45-year-old male with a healthy lifestyle. B. A 30-year-old female with a family history of heart disease. C. A 50-year-old male who is a smoker. D. A 60-year-old female with no previous health issues. Answer: C. A 50-year-old male who is a smoker. Explanation: a substandard risk is classified as someone who has a higher likelihood of mortality compared to the average population due to health conditions, lifestyle choices, or other factors. In this scenario, the 50-year-old male who is a smoker represents a higher risk, as smoking significantly increases the likelihood of various health complications and, consequently, mortality. The other options represent low risks based on age and lifestyle factors, making them more likely to be classified as standard or preferred risks. Question 14. Sales and marketing of term life insurance. In the context of ethical sales practices, which of the following actions is considered a violation of the duty of disclosure? A. Accurately explaining the terms of the policy to the client. B. Concealing relevant information about policy exclusions. C. Providing clients with clear documentation of all fees. D. Offering a needs analysis to assess the client's coverage requirements. Answer: B. Concealing relevant information about policy exclusions. Explanation: the duty of disclosure obliges insurance agents to provide clients with all relevant information that could affect their decision-making regarding the purchase of A policy concealing information about policy exclusions is a violation of this duty, as it misleads the client about what is covered and can lead to significant financial consequences if a claim is denied later on. Ethical sales practices require transparency and honesty throughout the sales process. Question 15. Policyholder rights and responsibilities. Which of the following best describes the right of a policyholder to convert a term life insurance policy into a permanent policy? A. The policyholder can convert at any time during the term without any conditions. B. The policyholder must provide evidence of insurability to convert the policy. C. The conversion option is typically available only within a specified period during the policy term. D. The conversion can only happen if the policyholder pays an additional premium upfront. Answer: C. The conversion option is typically available only within a specified period during the policy term. Explanation: most term life insurance policies include a conversion option that allows policyholders to convert their term policy into a permanent life insurance policy without providing evidence of insurability. However, this right is usually subject to specific conditions, such as a limited time frame within which the conversion can occur, often outlined in the policy documentation. Understanding these rights is crucial for policyholders considering their long-term insurance needs. Question 16. Claims process. In the event of a claim denial, what is the best course of action for a policyholder who believes their claim was wrongfully denied? A. Accept the denial and move on. B. Immediately file a lawsuit against the insurance company. C. Review the denial letter, gather additional documentation, and file an appeal. D. Contact the insurance agent to request a refund on the premiums paid. Answer: C. Review the denial letter, gather additional documentation, and file an appeal. Explanation: when a claim is denied, the policyholder should first carefully review the denial letter to understand the reasons for the denial. After gathering any additional documentation that may support their claim, the policyholder should file an appeal with the insurance company. This process is critical as it may resolve the issue without resorting to legal action, which can be time-consuming and costly. Engaging with the claims process respectfully and methodically increases the chances of a favorable outcome. Question 17. Practical applications. Mr. Thompson is 40 years old and considering a term life insurance policy to cover his mortgage of $250,000. He expects to pay off the mortgage in 20 years. Which type of term policy would best suit his needs? A. Level term insurance for 20 years. B. Annual renewable term insurance. C. Decreasing term insurance for 20 years. D. Increasing term insurance for 20 years. Answer: C. Decreasing term insurance for 20 years. Explanation: Mr. Thompson's need for coverage directly correlates with his mortgage, which will decrease over time as he makes payments. A decreasing term insurance policy is specifically designed to match this decreasing obligation, providing appropriate coverage that aligns with the amount owed on the mortgage. A level term insurance policy would not be suitable since the coverage amount would remain constant, which is unnecessary as the mortgage balance decreases. Increasing term insurance would also be inappropriate as it would not match his decreasing debt needs. Question 18. Theoretical knowledge. How does the time value of money concept impact the pricing of term life insurance premiums? A. Insurers do not consider time value in premium calculations. B. The concept encourages insurers to set lower premiums based on inflation. C. Insurers invest premiums to earn returns that can offset future claims. D. Premiums are calculated only on the risk of the insured without regard to time value. Answer: C. Insurers invest premiums to earn returns that can offset future claims. Explanation: the time value of money concept holds that money available today is worth more than the same amount in the future due to its potential earning capacity. Insurers invest the premiums they collect to generate returns, which can help offset future claims and stabilize the company's financial position. By understanding this principle, insurers can set premiums that reflect both the risk of insuring individuals and the expected returns from their investments, making it a crucial element in premium calculations. Question 19. Unique aspects of Michigan term life insurance. Which of the following unique aspects must agents consider when selling term life insurance in Michigan? A. Federal regulations solely govern insurance sales. B. Michigan law allows insurers to refuse coverage based on pre-existing conditions without any restrictions. C. Agents must be aware of specific state regulations that govern premium rate adjustments. D. There are no consumer protection laws in place for term life insurance in Michigan. Answer: C. Agents must be aware of specific state regulations that govern premium rate adjustments. Explanation: in Michigan, insurance sales are governed by both state and federal regulations. Agents must be familiar with specific Michigan laws that dictate how and when premium rates can be adjusted, including regulations surrounding consumer protections. For example, the Michigan Insurance Code outlines procedures for rate filings and the conditions under which rates can be changed. Understanding these regulations is essential for agents to ensure compliance and protect their clients' interests. The other options are incorrect as they misrepresent Michigan's regulatory environment. Question 20. Problem-solving skills. A client, Ms. Lee, approaches you seeking term life insurance. She is 50 years old, has a family history of diabetes, and has been diagnosed with high cholesterol. What should be your first step in assisting her? A. Recommend the cheapest term life policy available. B. Suggest a permanent life insurance policy instead. C. Conduct a needs analysis to determine her coverage requirements. D. Encourage her to seek medical treatment before applying. Answer: C. Conduct a needs analysis to determine her coverage requirements. Explanation: the first step in assisting Ms. Lee should be conducting a comprehensive needs analysis to assess her financial obligations, dependents, and overall insurance needs. This process will help identify the appropriate coverage amount necessary to provide financial support for her beneficiaries in the event of her death. It will also take into account her age and health conditions, which are important but secondary considerations at this stage. By understanding her financial situation and insurance requirements, you can recommend a suitable term life insurance policy that meets her needs effectively. Additionally, this approach builds a relationship of trust and ensures that the client feels supported in making an informed decision regarding her life insurance. Question 21. Characteristics of term life insurance. Which of the following best describes the primary characteristic of term life insurance? A. It builds cash value over time. B. It provides coverage for a specific period. C. It is always renewable without health assessments. D. It guarantees a payout regardless of the insured's health. Answer: B. It provides coverage for a specific period. Explanation: term life insurance is designed to provide coverage for a specific period, typically ranging from 1 to 30 years. Unlike permanent life insurance, it does not build cash value and does not guarantee a payout beyond the term unless the insured dies during that period. While some term policies can be renewed, they may require health assessments or increased premiums. Understanding this characteristic is essential for distinguishing term life insurance from other types, such as whole or universal life insurance. Question 22. Legal and regulatory framework. Under the Michigan Insurance Code, which of the following is a requirement for agents selling term life insurance? A. Agents must provide clients with a guaranteed renewal option. B. Agents are required to disclose all material facts related to the policy. C. Agents must have at least 5 years of experience before selling policies. D. Agents are not allowed to discuss policy riders. Answer: B. Agents are required to disclose all material facts related to the policy. Explanation: according to the Michigan Insurance Code, agents are obligated to provide full disclosure of all material facts regarding the insurance policies they sell, including terms, coverage, exclusions, and riders. This obligation ensures that consumers can make informed decisions about their insurance needs. Failure to disclose material facts can result in penalties for the agent and may impact the validity of the policy. Understanding these regulations is crucial for maintaining compliance and protecting consumer rights. Question 23. Policy provisions and riders. Which of the following riders allows the policyholder to increase the death benefit without undergoing additional medical underwriting? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Terminal illness rider. Answer: C. Guaranteed insurability rider. Explanation: the guaranteed insurability rider allows the policyholder to increase their death benefit at specified times without providing additional medical evidence. This rider is particularly beneficial for individuals who anticipate changes in their insurance needs due to life events, e.g., marriage, birth of a child, but may not want to undergo further medical underwriting. Understanding policy provisions and riders is essential for tailoring policies to meet clients' evolving needs. Question 24. Types of term life insurance policies. What is the primary feature of a decreasing term life insurance policy? A. The premiums increase over time. B. The death benefit decreases over time. C. It offers A cash value accumulation. D. It is guaranteed to be renewable each year. Answer. B. The death benefit decreases over time. Explanation. Decreasing term life insurance is designed so that the death benefit decreases at a predetermined rate over the life of the policy. This type of policy is often used to cover obligations that decrease over time, such as a mortgage. Understanding the characteristics and intended use of various types of term policies is critical for making appropriate recommendations to clients based on their financial situations. Question 25. Premium calculation and underwriting. Which of the following factors is NOT typically considered in the underwriting process for term life insurance? A. The applicant's credit score. B. The applicant's medical history. C. The applicant's occupation. D. The applicant's lifestyle choices. Answer A. The applicant's credit score. Explanation. While an applicant's medical history, occupation, and lifestyle choices, such as smoking or high-risk hobbies, are critical factors in the underwriting process for term life insurance, the applicant's credit score is generally not a consideration. Underwriting primarily focuses on evaluating the risk associated with the individual's health and lifestyle to determine insurability and premium rates. Understanding underwriting criteria is crucial for providing accurate coverage recommendations. Question 26. Claims process. When a beneficiary files a claim for a term life insurance policy, which of the following documents is typically required? A. The insured's medical records. B. A copy of the original insurance application. C. The death certificate of the insured. D. A statement from the agent who sold the policy. Answer. C. The death certificate of the insured. Explanation. The death certificate is a critical document required when filing a claim for a term life insurance policy, as it verifies the death of the insured and the circumstances surrounding it. While the documents, such as the insurance policy itself, may also be needed, the death certificate is essential for initiating the claims process. Understanding the claims process is vital for agents to effectively guide beneficiaries in fulfilling the necessary requirements. Question 27. Practical applications. Mr. Thompson is considering a term life insurance policy and has 2 children, ages 10 and 15. What is the most important factor he should consider when determining the coverage amount? A. The premiums of different policies. B. The duration of the term. C. His current income and future financial obligations. D. The potential for policy dividends. Answer. C. His current income and future financial obligations. Explanation. When determining the appropriate coverage amount for term life insurance, Mr. Thompson should consider his current income and any future financial obligations, such as college tuition for his children and other living expenses. This analysis will help ensure that his dependents will be financially secure in the event of his death. While premiums, duration, and policy features are important considerations, they should align with the primary goal of adequately protecting the financial well-being of his family. Question 28. Emerging trends in term life insurance. What is a current trend in the term life insurance market that reflects changes in consumer behavior? A. Increased sales of traditional whole life policies. B. A shift towards shorter term policies. C. Greater demand for term policies with cash value. D. A decline in online policy purchases. Answer. B. A shift towards shorter term policies. Explanation. In recent years, there has been a trend toward shorter-term policies as consumers increasingly seek flexibility and affordability in their insurance options. Shorter terms, such as 10 or 15 years, often align better with specific financial goals, such as covering a mortgage or educational expenses. Understanding these market trends allows agents to tailor their offerings to meet the evolving preferences of consumers. Question 29. Time value of money and life insurance. If a term life insurance policy has a death benefit of $500,000 and is projected to be paid out in 20 years, how does the time value of money impact the present value of this benefit? A. It increases the present value significantly. B. It decreases the present value significantly. C. It has no impact on the present value. D. It doubles the present value. Answer. B. It decreases the present value significantly. Explanation. The time value of money (TVM) principle states that money available now is worth more than the same amount in the future due to its potential earning capacity. As a result, the present value of a future death benefit of $500,000 to be paid out in 20 years will be significantly lower than its nominal value due to discounting. This concept is crucial for understanding how life insurance benefits compare over time, especially when evaluating the long-term financial implications of insurance products. Question 30. Policyholder rights and responsibilities. What right does a policyholder have under a term life insurance policy regarding premium payments? A. The right to pay premiums at any time without penalty. B. The right to change the due date of premium payments. C. The right to reinstate a lapsed policy within a specified period. D. The right to receive a cash refund of unused premiums. Answer: C. The right to reinstate a lapsed policy within a specified period. Explanation: policyholders typically have the right to reinstate a lapsed term life insurance policy within a specific period, usually within 30 days to 2 years depending on the policy terms, by paying any past due premiums and possibly providing evidence of insurability. This right helps protect policyholders from losing coverage due to missed payments, provided they act within the reinstatement window. Understanding policyholder rights is essential for advising clients on maintaining their insurance coverage effectively.